SMT divergence, understanding reversals, understanding the top and the bottom, understanding when will a smart money be in the market. And today's videos, we're going to be talking about SMT divergence. We're going to be talking about the false SMT divergence, and we're talking about the true SMT divergence. And we're going to be talking about the higher time frame SMT divergence as well, because the higher time frame SMT divergence affects your daily bias, right? If you have an SMT divergence on the daily or the weekly, that would cause your bias to shift, right, without it tapping the key level on one correlated pair while tapping the key level on the other correlated pair, right? So SMT divergence is a very important concept. Why is it very important? Because it affects your daily bias. And now let's get into it, right? So on the weekly time frame, let's start off with the false SMT divergence and how can you avoid this? And the way you know if a SMT divergence will hold and not be a false SMT divergence is through short-term drawn liquidity and long-term drawn liquidity, right? And this right over here is a bearish SMT divergence. As you can see in the weekly time frame, we're going from a weekly ERL to IRL, right? As you can see, very simple. Weekly ERL to IRL, right? ERL to IRL. And this SMT right over here prevented the soup happening, right? It prevented the Ferrari gap to get tapped. While on this candle, it tapped it, right? But market still went up. How was this a false SMT divergence? Now let's get into our daily time frame to know if the SMT divergence will hold or not. On the daily, when the SMT divergence happened, we're going from a daily ERL to IRL. So once this IRL gets met, our weekly objective is still here. Let's see if this weekly ERL will still hold, or yes or no. Let's see if this weekly SMT divergence will still hold or not, right? It's through short-term drawn liquidity, right? So market did a daily ERL to IRL, so market goes through phases, right? Market can't go up or down, can't go to the weekly objective alone, right? It has to go through phases to it, right? So market went from a daily ERL to IRL, right? As well as a daily CRT to the downside. So you can see how the market went below the IRL, it went to the CRT, right? Now, once the market closed above this IRL again, now market's going from a daily IRL to ERL. So once the market goes over here back, and this is how you know if the SMT divergence will hold or not. So once the market goes above this, that means SMT divergence will high likely not hold it because market is pointing up to the fair value gap. Market wants to go to the fair value gap, right? So this SMT divergence would have been false because of the short-term drawn liquidity, right? Now let's go to this other example. Why did this SMT divergence hold while this other one did not? Let's go to the daily time frame. This was a daily time frame right over here. Why did this daily SMT divergence hold while this one did not, right? Because in the daily time frame, if you're a dumb money trader, you would have looked in for shorts and you would have gotten wrecked with this big ass candle to the upside, right? Why would have gotten wrecked? Because you're thinking market goes from a daily IRL to ERL, right? Without knowing that this SMT divergence, and you would have gotten wrecked. So now let's go to the weekly. Weekly, we're going from weekly ERL to IRL, weekly CRT to the upside, right? So our long-term liquidity in a weekly time frame is bullish, right, to the upside. In this case, our long-term liquidity is bullish, but our short-term liquidity was bearish, right? So we would have gone to short-term. In this case, why did this one hold? Because this SMT divergence is aligned with the long-term, right? So this SMT would have worked out because now once this SMT divergence is preventing from this getting souped, this low from this IRL to ERL getting souped. So now we will think automatically we're going from a daily ERL to IRL, right? So now this IRL, we're not gonna go to this IRL, but we're gonna go to this IRL all over here, right? Because this IRL is already here, right? It's already filled maximum rate. I mean, it doesn't matter if it's filled maximum rate, right? But market high likely will go to a new fair value gap. So daily ERL to IRL as well. We're going to the weekly objective, which is the CRT, because you guys know we optimize and we prioritize CRT more than IRL to ERL. So in this case, we would have gone based out of the CRT. So we would have gone based out of the CRT of the weekly. So there's a weekly CRT to the upside, pointing to the upside. There's two weekly CRT pointing to the upside. So would have just not counted this, this ERL to IRL will just go out of the weekly CRT to the upside right over here. So we would have not cared about this fair value getting tapped. Would have just gone up from here, right? So this is how this SMT hold it. Why does SMT hold? Because this SMT went with the long-term drawn liquidity. Long-term liquidity is over here. While in this case, our long-term liquidity is over here, but our short-term liquidity was to the downside, right? So ERL to IRL. Now this short-term liquidity is right back to the upside. So this is how this SMT divergence did not work out. While in this case, it worked out because this one went to the long-term drawn liquidity, right? And now let's talk about how to confirm a SMT divergence. What's the confirmation of a SMT divergence? It's very simple. All you got to look for is a model number 1 for the confirmation of the SMT divergence. So SMT divergence happened from here. You could say this scanner right over here. Well, this scanner did not, these two candles did not approach each other, right? So we would have counted from all over here, but this scanner had SMT with this other candle right over here, right? So once market purchased out this candle, so this would have been considered as like your confirmation, or you could have gone this as well, right? And your confirmation would have been the CISD. The CISD was out of the body, it's still valid, right? So market still respected its low and eventually went up here, and that's you got a confirmation, right? So now for this other one that we showed, the other example, then we had a confirmation on this SMT with CISD, right? You can see we had a confirmation for the CISD right over here, right? So you see right over here, it's confirmation. Market plummeted to the downside, right? So it confirmed that market wants to go down. The SMT was confirmed, but after a short moment after the market, met a short-term liquidity, and now short-term liquidity is met with the long-term liquidity, right? Without this SMT holding, so SMT did not hold, so market went to the long term, hitting a goal, right? Now that's that. Now let's talk about the protocols of it. When should you trade it? When should you use it? What are the protocols? What are the things you need for the SMT divergence to be correct, right? To be a powerful, high probability SMT divergence. As you guys know, the confirmation of the SMT divergence is a model number 1, basically the CISD. What are the protocols? It must be around a key level. So you can see right over here, it is around a key level. You can see market is going from a daily ERL to IRL, because market went from IRL to ERL. This ERL prevented this ERL prevented from getting soup. This SMT prevented from the ERL getting soup. So we're going from a ERL to IRL all over here. Why do we not count this? Because this fair value gap has already been filled so much, and market will not just go from this fair value gap, right? Market needs to go to his higher time frame. So market needs to move, right? So market would have gone to this right over here, right? So that's that. These are on the key level. It happened at a Pacific time. So what I mean by the Pacific time, you see this candle was at Wednesday, this candle was at Friday, right? So there was a time in there, right? For the intraday time is either has to be a London session or a New York session. Those are the highest probably time. And what else? What is the next protocol for this, which is the most important, is the having a pre-existing trade idea to this SMT. So I already had a pre-existing trade idea to the upside. What was the pre-existing trade idea? Daily ERL to IRL, daily SMT to the upside, and as well as weekly ERL to IRL, right? So we had a pre-existing trade idea to the SMT. So that's why you hold it. Thank you for watching. This is how you pick the right SMT divergence, and this is how you prevent false SMT, because SMT divergence happen like every hour. Every hour SMT divergence, but most of them are false because you need to have these protocols, right? And as well as you need to focus on the long term and the short-term liquidity to knowing if this SMT divergence will hold. So if the long-term liquidity is to the upside, but short-term liquidity is to the downside, right? You would have gone out the short-term. Eventually, the short-term liquidity will never go against the long-term. The short-term will lead up to the long-term, right? You can see the short-term liquidity eventually led up to the long-term liquidity, right? So that's why the SMT divergence failed. So we're still looking for longs here, right? You can see right over there. And yeah, so what does this work out one more time? Because this short-term liquidity is going, this SMT divergence is going to long-term drawn liquidity. So that's why it worked out, right? So thank you for watching. This is a SMT divergence. Really complicated concept in my in my eyes. It's complicated. It's kind of hard to use, but it's cool, right? Or again, I'm getting hang of it. That's why I made a video on this, right? This is how I use it. These are the protocols. These are none of these protocols are not of my protocols. These are people who actually created them, right? Not for me. So thank you for watching. Like, comment, subscribe, share. I'll see you guys in the next video. Go on my Discord, and yeah, actually, I'll see you guys inside my Discord. Peace out. Link in description.